In my last updates on interest rates, I mentioned that the Federal Reserve now turned their attention from CPI data to PCE data, which I will explain here. And also, they wrap up the meeting in Jackson Hole, Wyoming. And a lot of people wondering why all these official policymakers and also financiers, come all the way from Washington, D.C. and New York, all the way to, Jackson Hole to have such an important meeting. Well, there's a little fun facts there which I'll share with you. But first of all, on the CPI. Well, CPI Consumer Price Index basically is an inflation indicator on the pricing level of all the everyday items. So now the Federal Reserve has pretty good confidence on a control on inflation, and inflation has been on the way down sustainably. So now they're paying attention to PCE, which represent personal consumption expenditure. Now, the price could be high or could be low, but as long as everybody's still spending, then the economy is going well, right? But regardless of the pricing level or the CPI data, if PCE is going down, now that's a bigger concern because it's an indication on the economy is weakening. Particularly, the entire US GDP, gross domestic product, basically 70% of GDP growth is a consumer spending. If consumer spending is showing sign of weakness, that means there's a risk that economy is slowing down. So the Federal Reserve responsibility is to make sure that not to let the economy slide into a recession. So they are really trying to keep a good balance to make sure that the economy is growing modestly and not slipping into recession. Another important piece of data they're looking at is the labor market. So every month, the Federal Reserve, they will be analyzing how many new jobs are being created for the month and also how many unemployment insurance claims there are, whether they're new claims and also existing claims. That's how they evaluate and analyze how healthy the economy is in order to determine their direction in terms of interest rates. Now, the market is trying to guess, whether they're going to cut 25 or 50 basis points. So I would say that, if they're starting off by cutting 50 basis points, it may send a signal to the markets that, the economy is in trouble. So unless it's absolutely necessary, otherwise, I think they may start with, just 25 basis points and then go from there.